Global financial markets after the latest NFP disaster. Welcome to The Explainer. Today, we're breaking down that absolutely shocking new non-farm payrolls data, or NFP, that literally just sent shockwaves across the globe. It's basically flipped Wall Street right on its head. So if you want to understand where the smart money is panicking right now and exactly where it's flowing instead, let's get right into it. Okay, let's dive into this because this number right here, this is the massive shock factor that started the whole thing. Minus 23,000. The U.S. economy didn't just, fail to add jobs in July. It actually went in reverse. It lost 23,000 jobs. For an economy that leans so heavily on job creation as a leading indicator of consumer spending, seeing a negative number here isn't just a tiny miss. It is a disastrous macroeconomic red flag, and honestly, nobody was fully prepared for it. The official data from the Bureau of Labor Statistics really paints a stark reality of this drop. But wait, here's the paradox that has a ton of people scratching their heads, right? Despite losing 23,000 jobs, the official unemployment rate actually dropped down to 4.1%. I mean, how does that make any sense? Well, the underlying cause is actually pretty grim. The rate dropped not because people magically found work, but because a massive chunk of the labor force just got discouraged. They simply stopped looking for jobs altogether. And when they stop looking, they fall right out of the calculation, artificially shrinking the denominator and pushing that unemployment percentage down. So what does this all mean? Well, this catastrophic data set triggered an immediate, and I mean violent, psychological paradigm shift on Wall Street. For the longest time, the overriding narrative dictating market moves was inflation fear. Just, the anxiety that prices were rising way too fast and the Fed would have to keep squeezing the economy. But instantly, literally in the blink of an eye, the focus shifted entirely to recession fear. The market isn't worried about things running too hot anymore. They are absolutely terrified the engine is stalling out completely. And this brilliantly illustrates exactly what happens when recession fear takes the wheel. Starting over in the commodities market, we're seeing panic money explosively flowing into gold, completely piercing the $4,350 per ounce mark. This is the very definition of panic money rushing into a safe haven. When the stock market looks like a falling knife, investors run to gold to protect their wealth. The momentum we're seeing here is just undeniable. Now, if you're sitting there thinking, hey, I should jump on the gold train right this second, hold on, seriously, pause for a second. We've reached a strong supply zone. Despite this massive surge, gold is basically screaming that it is not a buying opportunity at current levels. Actually, for the skilled traders watching, this really opens up the door to look for counter-trend downward trades early next week. The panic essentially pushed it up way too fast, so a technical pullback is highly, highly likely. All right, let's pivot over to the Forex market because the US dollar is telling its own terrifying story right now. The DXY, the US dollar index, is showing some extreme weakness. It's suffering a severe sell-off that has literally plunged the dollar down to its lowest point since mid-June. It is completely drowning in selling pressure. So the absolutely crucial point here is figuring out where the dollar goes next. Based on the data, the DXY simply lacks any real momentum to mount a recovery. The downward target, it remains firmly set right at the 99-point zone. And why is that? Well, because with job losses this severe, the Federal Reserve's hand is forced. They don't just have to cut interest rates now. We can expect them to cut rates very aggressively to try and jumpstart this stalling economy. And as we know, lower interest rates fundamentally mean a much weaker dollar. Let's move to the stock market and see how this builds into an even wider panic. U.S. stock indices have been sitting pretty at historic all-time highs. But you know what? Those highs mean absolutely nothing when the cash flow just dries up. We're now staring down the barrel of a massive, panicked sell-off. The momentum needed to sustain all three major indices at these sky-high valuations, it just isn't there anymore. And this brings us to a really fascinating market dynamic. We're officially in a bad news is bad news environment. Usually on Wall Street, there's this kind of twisted logic where bad economic data is actually cheered on, right? Because it forces the Fed to lower interest rates and the party keeps going. But right now, the music has completely stopped. Investors are no longer cheering for those upcoming rate cuts. Instead, they are literally running for the exits because they realize the U.S. economy is weakening way faster than anyone forecast. They aren't celebrating cheaper money anymore. They are terrified of a hard landing where the economy crashes into a severe recession. Which leads us to the ultimate question that every single investor, trader, and institution needs to be asking right now. Is the U.S. economy truly heading for a hard landing? That minus 23,000 jobs report was the first major crack in the ice. And this immediate flight to gold, combined with the brutal sell-off in equities and the dollar, well, it shows us exactly what the smart money currently believes. You're going to want to keep your eyes glued to this space because the next few weeks of data will be absolutely critical. Thank you so much for joining me for this explainer. Stay focused, stay curious, and I'll see you in the next one.